let's begin with what motivated this paper, okay? So a few years ago, actually, like a couple of years ago, 2018-19, there was this surge of news on the finance, top finance journals. And I've taken a few headlines to kind of give you an idea of what the news was about, okay? So there were headlines, these are the headlines: don't go overboard. Are your directors serving on too many boards, okay? And then if, like, these directors are told, don't go overboard, and so on and so forth, okay? So these are all the headlines from top finance journals. This last one, BlackRock votes down record number of board directors in latest slam on overboarding. And this one, the last one, is actually from September 2020, which is like 2 weeks ago. So this is certainly an important overboarding, which is essentially, in simple words, directors sitting on too many boards, is an important point of concern. It's definitely something that has become very important for large investors and proxy advisors and has wider implications, as you're going to see, because they're voting according to these recommendations. And this surge of news a few years ago basically came in response to the change in policy recommendations by two of the top three proxy advisors, that was ISS and Glass Lewis, okay? So essentially, US, sorry, one second. I can't see my own slides. Yeah. Glass Lewis, for instance, made their policy a bit more stringent and said that they would only recommend directors who serve on no more than 5 boards. And interestingly, so this was stricter than earlier, which was, I think, 6 boards or 7 boards. But this is even more stringent for CEOs. That is, they would only recommend CEOs who sit on no more than 2 boards, where one board is their own board. So essentially just one more outside board, all right? So this is an example of Glass Lewis, but different proxy advisors can have stricter or looser recommendations. Or BlackRock voted against 728 directors for overboarding during this year's proxy voting season, and this was against 116 CEOs. So you can see that this has implications. And the reason for this concern of these changes in policy recommendations is basically what they say is that directors need sufficient time and energy in order to be efficient representatives of shareholders' interests, okay? And it's become even more important now because directorship has become more time consuming, as has been shown by this National Association of Corporate Directors annual survey. More accountable directors are held more accountable, they just generally require more time, right? But the question here is there really a need of concern of such stringent policy recommendations by these proxy advisors or large investors? And there already is research on that. So you'd be like, yeah, we know there's a whole strand of research on busy boards, busy directors, director distraction. But most of the prior research have exclusively focused on director distraction. And without going too much to save time, without going too much into the literature, but this literature has been there for a while. Okay, so earlier there was these cross-sectional analysis, and we got mixed results, both good and bad, of sitting on multiple boards. Clearly, there are some benefits of sitting on multiple boards, networking, informational advantage and whatnot. And there were these issues of disentangling attention from ability. It was like only very good directors are going to get a lot of offers to sit on multiple boards. And so it's like you're a highly capable director, but then you also have less time to give to your each directorship, etc. So then there's this mixed results that you get. But more recently, studies have used time-varying distraction shocks, similar to what we are going to do in this paper. And overall, there's a consensus in this literature that is director distraction results in negative repercussions for the firm in which the director sits as a director, okay? The question that we ask in this paper is, what about the effect of CEO distraction as a result of overboarding on their job as a CEO, right? And you could be like, yeah, but well, director distraction, CEO distraction, same, right? But interestingly, and there are these recommendations that are even more stringent for CEOs, but interestingly, there's actually no empirical evidence validating the concern that CEOs may also be distracted due to their directorship duties. And it's all this prior research that has been looking at director distraction actually makes sense because they're comparing two equivalent jobs, that is directorship with directorship. One of the directorship gets shocked or something happens there and you take out time from this directorship to give to another. But it's not a given, at least. It wasn't a given to us when we started that this necessarily has to be the case when we're talking about a CEO, because essentially, would the CEO even be distracted, one at all, or enough by something that, if you allow me to call it a secondary job, to possibly neglect their primary job? I call it primary job because presumably it's their primary source of income and also reputation. And this is something that was not, that's not a given or has not been analyzed in the literature. One, would they even be distracted? And the second is, even if they are, is it enough of a distraction to even be concerned about? Given all the potential benefits that you might get by sitting on multiple boards, is this something that we even need to be curtailing or not? What is the magnitude? Is it significant enough to have repercussions for the focal firm? By focal firm, I mean the CEO's own employing firm. Therefore, we basically fill this gap in the literature by asking the specific question, that is, what are the corporate performance consequences of CEO's distraction caused by their outside appointments? Sorry, I was trying to follow okay. So again, as I said, before moving on, we are placing ourselves into this distraction literature, but filling the gap on CEO distractions. Essentially, this paper is going to be about CEO distraction, except that I cannot possibly claim that we are the first one looking at CEO distraction, but interestingly, there's very, very limited research on CEO distraction. But one paper that I cannot get away without mentioning is the one by Bennett et al. It was published in 2020, but it has been around since forever. So it was a working paper in 2006, and it has been cited by anyone who ever works on this literature. And essentially what they do is that they look at, they document decline in firm performance following a hospitalization of the CEO. The idea is that, CEO is going to be distracted, or it's going to take CEO's time away from his focal firm when he is in a hospital, at least in their working paper, they looked at the family members' deaths as well, and they report that there's a decline in firm performance, right? But we differ from them in the sense that we focus on CEO distraction arising due to professional concerns. And here, I want to highlight one thing. It's not as simple as saying, oh, they use one measure of CEO distraction and we're going to use another measure of CEO distraction. Actually, it's a little more than, while it's true, it's a little more than that, because any sort of personal distractions, be that hospitalization, death of a family member, marriage, divorce, childbirth, fall out of the realm of policymaking and hence cannot be regulated. What we are actually trying to showing informs policy recommendations, and it's timely because it's already an important concern for the investor. So the consequences arising from professional distractions actually allow for useful policy changes. Okay, so what do? We focus on transient attention-grabbing events that happen at firms where CEOs serve as directors. And I'll get to it in a minute, what those attention-grabbing events are. CEOs should presumably allocate most of their time and effort on the firm where they hold their CEO title. We are by no means claiming that because of the distracting event, all of a sudden they're going to give most of their time to the directorship. They may continue to give majority of their time to still their CEO-ship, but using the concept of limited attention, given that attention is a limited resource, when a distracting event happens, it might imply shifting attention away from another task, and hence higher distraction would imply temporarily less attention to the operations of the focal firm. Okay. So this is our measure of CEO distraction. It has essentially three components. So the first one, which is the shock, which is the one in the middle, this one. Shock captures whether an attention-grabbing event occurs in the directorship firm. So this is the terminology I'm going to be using. Focal firm is the one in which the CEO sits as a CEO. Directorship firm is the firm in which the CEO sits as a director. So shock is whether an event occurs in the directorship firm or not. Omega DT represents how much CEOC cares about this shocked directorship, and omega IT captures how much CEOC cares about his own firm in his entire portfolio. Okay, and I'm going to go get in detail of how we measure this. But overall, essentially, this measure is then going to be a firm level proxy for how much the CEO is distracted in a given year due to their role as independent director in another firm. And higher values of this measure indicate when the CEOs are more distracted in the focal firm. Okay, so a little bit in detail, the shock, which was whether the attention grabbing event occurs or not, is basically going to be an indicator variable. So we use different measures, but as in the baseline, it's going to take value 1 whenever directorship shows extreme returns. By extreme returns, we mean top or bottom, so extreme neutral returns, top or bottom 10, 5, or 1% returns from the distribution of firm D, okay? As a robustness, we did extreme earnings and volatility. Alternatively, to give a concrete idea of what exactly could an attention grabbing event be, we look at specific events that might be attention grabbing, and we tried to choose the events which would more or less be neutral. For instance, mergers and acquisitions, CEO and director turnover, or retirement. I'm going to say a little bit more over why we chose neutral returns in these events when I come to the results, because I think it would become clearer when we're looking at the results. Omega DT indicates a market value weight a directorship D represents over the total portfolio of directorship in a given year T. And omega IT captures how important. So omega DT, so before I move on, just to give an idea, a simple exercise, it's like imagine the CEO sits in 2 more directorships. One is like, I don't know, Google, and the other is like much less important, and both of them get shocked. Which one is he going to give more time to? So this is what it's trying to capture. This is a little bit inspired from a Solis and also by Kempf paper. Both of them weighted using like this. That is the one that has a greater market value. You might actually give more importance to that directorship. And omega IT captures how important your own firm is to you. The idea for adding this weight was essentially that imagine you sit as a CEO in a very small firm, but somehow you sit in a directorship of a very important, super big firm, right? And it's like, and few other directorships. You may want to really, and you're at, I'm just making up a story here, but you may really want to move into the big leagues and whatnot, and you want to really do well and be seen as a capable person. And so therefore, you might be more distracted if your own firm is very small compared to the shocked directorship. Okay, so for the data and sample, we use standard sources for the CEOs and directors, Codex and risk metrics, then CRS, BCompuStat, STC Platinum, etc. So some of the descriptive statistics that are of importance I've put here. We have about 4,200 firms over the period 1999 to 2016, about 5,900 CEOs in our sample, about 1,150 have been distracted at least once in their tenure, and 27% CEOs sit on at least one other board. Yeah. So this is the empirical setting. This is the empirical setting where return on assets is the, ROA is the return on assets of firm I in year T. Distraction is the measure for CEO distraction, which takes a non-zero value if the CEO is distracted. It's basically that measure that we talked about earlier. Controls are at different levels. So firm controls includes firm size, market to book value, leverage, cash, sales growth, etc. Then there are these board controls, that is independent directors, proportion of busy directors. I think, because I'm not being able to read all the comments, but I think we also have control for whether the directors sit as directors in a related industry. Not sure, I would have to double check, but board tenure, board size, etc. CEO's controls include, the tenure of the CEO, age, and gender. And then of course we include firm fixed effects, year fixed effects, and industry year fixed effects. Okay. So before moving on to the main results, what we wanted to do was to find some indicators to validate the relevance of our shocks or our attention-grabbing events. So basically what we want to see is whether these events are actually either distracting or distracting the CEO or demanding their attention by possibly increasing their workload, okay? So what we thought of is board meeting frequency of the shocked directorship. That is, the directorship that got shocked or got the attention-grabbing event, if they increase their board meeting frequency, means that the CEO who sits as a director in that shock directorship would have to attend those meetings, okay? So the first thing that we look at is the association between our shocks or between our distraction measure and the board meeting frequency of the shocked firm. Now that alone is definitely indicative of the fact that potentially the CEOs may have more workload now, but it's possible that the CEO says, okay, yeah, I know you're going to have more meetings now, but I can't come because my CEOship is really important to me, right? So it's not the end all. It's possible that they don't attend these extra meetings, right? But this coupled with the board meeting absence might give us a complete picture. It's like not only that the shocked directorship has more meetings, but if their meeting absence at least remains the same, if not go down, then that would be indicative that CEOs are attending these extra meetings, okay? Now, before showing these results, I want to highlight that board meeting absence is a very, board meeting in attendance is a very crude measure that we have because we don't have it, we can't see that whether the CEO is actually attending the meeting or not. We have this measure simply for the entire board of the shocked firm, and we also have it even more aggregate, that is whether the board missed the proportion board missed more than 25% of the meeting. Okay, so it's very crude, but it's still suggestive that what we find is that the number of board meetings indeed go up for the shocked firms compared to not shocked firms, and that the board meeting in attendance or board meeting absence actually goes down, or definitely not up if you want to be safer. So not only that the number of board meetings are increasing in the shocked directorship, the attendance remains same or goes down, which indicates that the workload for the CEOs has increased or that they are potentially distracted. Another test that we thought of was trading frequency. That is, there are other studies that have used this as an indicator for distraction. And the idea here is that to be able to trade, you need to be attentive. You need to have the information, and you need to be attentive towards that stock. And when you're not paying attention, you should potentially see a decrease in the volume of, in the frequency of trading. So this is trading frequency by the CEOs of the stock of the focal firm. And indeed, we find here that the number of trades goes down, and that most of the result is actually coming, that this is being driven by the sales of the stock. Okay. So then after hopefully convincing you that CEOs are distracted due to these distraction attention grabbing events, let me show you the main result that I'm going to focus on, okay? So which is that what is the effect of CEO distraction on the operating performance of the focal firm, okay? So here we have neutral shock, and then I further disaggregate it into negative and positive shock. And I said earlier that I was going to talk a little bit more about, using returns, which, at the offset may not seem ideal. So this 10% neutral shock 10% means the top and bottom 10% of the distribution, et cetera. So even if, so basically 5%, 1%, which essentially kind of also, if you think about it, highlights the extremity or extremeness of the shock. If you think of the distribution, it's like, being in the 1% of the extremely good or bad, it's like this is a really high shock. And interestingly, what we find is that the magnitude increases with the extremeness of the shock as well. That is the consequences or the negative effect on the performance of the focal firm is significantly more, the more extreme the shock is. And then we can see that the results are actually robust, not only to the definition of extremeness, but also on negative and positive shocks. And the reason for using neutral shocks was that one could argue, and this here I would like to go back to Jife's, I think, fourth point, where you mentioned, how extreme stock returns may contain some common fundamental shocks to, both firms, related industry, supply chain, etc. Yes, this is one of the reasons we're also using some other specific events, but that reasoning would only hold true if we were just using negative shock, right? And then for the positive shock, we would see a positive effect. And this is also a little bit, again, if I understood your other reverse causality story, again, would only hold true for the negative shock. And that's why we wanted to highlight the positive shock as well, that even if a firm is doing exceptionally well, I don't know, some .com bubble, think of an amazing deal comes through, still the directors are going to sit in a board meeting and discuss that and give their time and whatnot. And so we see a negative effect, even of an extremely positive shock. And that was the reason for using neutral shocks and then showing you negative and positive. And I think that this kind of alleviates, even though we had the same concern, we also had the concern of the ability of the person, maybe that's what's driving it. He's the director and he's a horrible director and also horrible CEO, and then we see negative for both of them because of his inability. But that again wouldn't hold true when we look at positive shocks. So this was the reason for going for negative and positive shocks. So if we focus a little bit more on the magnitudes, as I said, we can see that they're increasing in the extremeness of the shock. And if you were to interpret them, it's essentially that a unit increase in CO distraction results in a 4.2 pp lower return on assets. And this implies that a 1 standard deviation increase in distraction reduces focal firms' mean return on assets by 5.6%. To put it a little bit more in context, most of these studies on director distraction, or the most recent one using time variant shocks, report focal firms' mean ROA, return on assets, being affected by 2.5%, something in this ballpark. So what we're noticing is pretty much double the effect of director distraction, and that is using this 595, by the way. So this is the one that I'm interpreting. It's actually 14 point something. So this effect is significantly more over here, which makes sense actually, because a CEO is very important for a firm compared to one director. So we find statistically and economically significant effect of CEO distraction on operating performance. We also look at these specific events like CEO turnover, CEO retirement, director turnover, target, M&A. And the reason we chose specifically these, there are a few others that we did try that did give us result as well, and few that we want to try. But the reason we kept these was that they're very neutral or potentially neutral in their nature, because CEO turnover or CEO retirement doesn't have to be a negative thing or a good thing. Anyway, again, so keeping in line with trying to alleviate the concern that I had mentioned earlier. But we were thinking of accounting restatements or scandals and lawsuits, etc., which would definitely be attention grabbing, and we can see more results. But I'm open to feedback if you have any other ideas for specific type of results, specific types of events. So what we see is that even these specific events give us, we find that the operating performance of the focal firm is affected significantly negatively by CEO distraction. Okay. I have a few minutes, so even if I can't go over all of these, I thought I would be late, and so I just wanted to be able to say these. But I'll go over one of these, a few of these, and then if I'm running out of time, I'll just give you an idea of what we do next. So next, what we do in this paper is that we try to see when our CEO is more distracted, or try to kind of validate if our story makes sense. If this makes sense, then we would expect the distraction to be higher or result in have a stronger effect when for instance, a CEO sits as a chairman of one of the important committees in the firm. There's this distracting event that happens, such as CEO turnover, and you're a chairman of a nominating committee. You cannot shirk off your responsibility very easily, and of course then that we would expect that they're going to be more distracted and the focal firm is going to be more affected. So what we basically, that's what we look at. We look at the three committees, which are three monitoring committees that are audit, compensation, and nominating. And what we find is that if most of the result comes from, so here, by the way, sorry, here distraction chairperson is not an interaction variable. It's essentially if the distraction is coming from a directorship firm in which you sit as a chairperson for a committee, then the effect on your focal firm performance is going to be this, okay? And we see that, most of the focal firm is going to suffer more if you sit as a chairperson on the committee or if you are a member of a specific one of these three committees. We don't specifically find any significant effects when we disaggregate the committees. It could be a power issue, it could be that we don't see anything. But then again, trying to see whether it makes sense, when you look at director turnover, it would make sense that, if a person sits in a nominating committee, is going to be affected more, it's going to be distracted more, and so focal firm would be affected. And that's what we find over here. Then we also think of geographical distance. The idea here is that if your focal firm and your directorship firm are really far away from each other, then it would take you more time to, let's say, attend those meetings, and you're going to be further away from your own, or gone away from your focal firm for a longer amount of time, and therefore there might be differential effect based on what the distance is between the firms. Again, there is definitely a finer way of doing this, which we haven't, but as of now, we've just taken the distance between them and looked at the median and then defined long distances, above the median and shortest below. But we plan to refine this difference, and we find that the greater the distance between the focal firm and the directorship firm, the stronger the effect on the performance of the focal firm. Then we look at CEO's personal characteristics and distraction. So essentially, so we look at three things. Ability, where ability is, we've just taken the measure as is from this paper in the Marjan. Age and tenure. And interestingly, so we didn't go into this with any specific hypothesis. I was thinking maybe a person is retiring and now directorship is going to become his future job anyway. So maybe it's that older directors, we see that older directors are going to be more distracted, but what we find actually is that, so with the ability, it's that the lower the ability, the greater the effect on the focal firms, the greater the negative effect on or the more significant the negative effect on the focal firm performance. The younger the director, the more effect, the younger CEOs are more distracted, or the younger the CEO, the more effect on the focal firm performance, and also the less experienced you are, the more distracted you are. Okay. Then we look at, and this might be the last table that I show you. Then we look at whether there is any, effect based on the governance. That is, this is governance of your focal firm. That is, even if a CEO is if you have a very strong governance in your focal firm, then maybe a CEO cannot afford two things. One, either the CEO cannot afford to be distracted enough for serious applications, because then he's going to be penalized, or it's that there is very serious monitoring, so they realize it and they rectify the effect. Either way, we basically measure corporate governance using independent directors, analysts following an institutional ownership, and we find consistently that if the focal firm has weak governance, distraction affects the firm performance negatively. Okay. So I'm just going to go over a few other things that we do without going in detail, and then I'll conclude so that we can talk about all these comments that we are getting. So alternate measures of performance, we look at Q, and then we also try to disaggregate return on assets into different margins. So gross margin, operating margin, and return on sales, and we see that the results are robust to alternate measures of performance. We look at whether this is a long-term effect or very small, and we see the effect only contemporaneously, even though we do, In the T+1, the effect is statistically not significant, but barely. But it seems that this distraction is very temporary, or the effect of the distraction is very temporary, only in the same year, and it's definitely not long lasting. This is also consistent with the previous literature on distraction. And then we look at alternative shocks to distraction using, instead of returns, using extreme volatility and extreme earnings. So to conclude, director overboarding is a point of concern for investors. Prior research has focused on consequences of sitting on multiple boards for the point of view of director distraction, but there is not much research on CEO distraction. We study the effect of CEO distraction specifically to do with this concern of sitting on multiple boards. And we find that CEO's focal firm suffers as a result of these attention-grabbing events in the firms among CEO's directorship portfolio.